Hello, I'm Madani Ariam here. This video is about comprehending cost basis, its role in investment, calculation, and tax implications. Introduction. When you sell an investment, the Inland Revenue Service IRS uses the asset's cost basis to calculate any taxable profit. If you sell an asset for more than your cost basis, you have realized capital gain and may owe taxes. Retaining investments for over a year often results in a lower tax rate than selling them within a shorter period. While many investors prioritize potential returns, understanding the cost basis is equally important. It determines not just what you earn, but what remains after taxes. Methods of determining cost basis. The IRS permits different methods to calculate cost basis, with the default being the first in, first out method. Alternatively, investors can use specific share identification or the average cost method. Each method has distinct implications for managing tax outcomes. Cost basis is the initial value or purchase price of an asset or investment which is crucial for tax purposes. It consists of the original purchase price and extra expenses such as fees or reinvested dividends. This figure is essential during tax season as it helps you determine whether you have made a profit or suffered a loss on your investment. When you make an investment, the IRS instructs you to report any profit or loss. To do this, you must compare your selling price to your cost basis, the amount you initially invested. This process is similar to how a retailer calculates profits by subtracting the cost of goods sold from the sales revenue. For instance, if you purchased 100 shares of stock at $10 each, totaling $1,000 without incurring any commissions or fees, and later sold them for $15 each, totaling $1,500, your cost basis would be. Understanding cost basis. Cost basis is a crucial element of effective tax planning for investors. Although the concept is relatively simple, accurate tracking can help investors save thousands in unnecessary taxes over time. For tax purposes, the cost basis begins with the original purchase price of an asset. However, it can change over time, much like how a home's value fluctuates when improvements are made, such as adding a new roof or remodeling the kitchen. Various events can lead to adjustments in your cost basis. For instance, if a company undergoes a stock split, such as converting one share into two, your cost basis is also divided. It is if you initially paid $100 for a single share and the company executes a 2-for-1 split, your new cost basis would be $50 per share, although the total remains the same. Additionally, reinvesting dividends increases your cost as you purchase more shares effectively. First in, first out. Under FIFO, the older share are considered sold first. This method is the default of most brokerages and simplifies tracking for stocks purchased in multiple lots over time. In rising markets, FIFO can result in higher capital gains as the oldest shares, often bought at a low cost, yield more significant profits. However, this may lead to higher tax liabilities. Specific share identification. The method allows investors to choose which shares to sell, providing flexibility to optimize capital gains or losses. For example, selling higher cost shares minimizes gains, while selling low cost shares maximizes reported gains. Investors must notify their brokerage in advance about which shares are being sold. Average cost basis. This method commonly used for mutual funds and some exchange traded funds, ETFs, calculates the average cost of all the shares by dividing the total purchase cost by the number of shares owned. It simplifies the process of determining gains or losses when shares are sold. Tax reporting and compliance. Brokerage firms are required to report the cost basis of taxable securities to the IRS. They typically use FIFO method unless instructed otherwise. The reporting rules vary based on the type of security. Equities reporting is required for investments made after January 1, 2011. Mutual funds and ETFs applicable for investments made after January 1, 2012. Other securities include bonds and options purchased after January 1, 2014. Investors receive 1099B from their brokerages summarizing gains and losses for the tax year. While brokerages assist in tracking the transactions, investors should maintain their records to ensure accuracy, especially when switching brokers or transferring accounts. Calculating cost basis. The cost basis typically starts with the investment's purchase price. The IRS permits including transaction costs such as stock trade commissions to reduce the eventual sales price. Tracking the purchase dates and values is essential if additional purchases are made. Reinvested dividends, often overlooked, increase the cost basis and reduce taxable gains. Examples: FIFO calculation. Suppose you purchase 100 shares of XYZ stock at $20 each in June and another 50 at $15 each in September. If you sell 120 shares, the cost basis using FIFO would be 100 times $20 plus 20 times 15. It is equal to 2,300. Average cost calculation using the same data, the average cost basis would be 120 times 100 times 20 plus 50 times 15 divided by 150. That goes to $2,200. For bonds, cost basis adjustments involve materializing the purchase price if it differs from par value. Mutual funds held in taxable accounts may generate yearly taxable events through distributions, which custodians or mutual fund companies track. Understanding cost basis is fundamental for investors aiming to optimize their tax outcomes. You can effectively control your investment portfolio and tax obligations by leveraging appropriate calculation methods and maintaining accurate records. I hope you like this video. It will be useful if you want to have investments. Thank you very much for watching my video. Thank you. Please do not forget to subscribe my channel. Thank you. Bye for now.